But we're here to talk this morning about manager selection, and I've got a great panel on standby here. So good morning to everyone. It's good afternoon where I am on the East Coast, and where Dagmar is, it's even evening. But our other two panelists, Lawrence and Michelle, are in California, very close by. So let me just go through a couple quick things that I need to cover. My name is Mark Heil. I'm institutional sales for Pacific Premier Trust, a division of Pacific Premier Bank. For those of you not familiar with us, we do custody of alternative assets. We work with self-directed IRAs, private fund custody, custody of retirement plans, both defined benefit and defined contribution. We work with broker dealers, ESOPs. We also have a connection online so people can sign up. Our clients are family offices, individuals, asset managers, broker dealers, investment asset sponsors, and so on down the line. Being that I work for part of a bank, you know what that means. It means I have a mandatory disclosure to make. Our compliance department requires this, so and it goes as follows. Information presented is for educational purposes only and is not intended as and may not be relied upon as tax, legal, investment, or other advice. Pacific Premier Trust performs the duties of a custodian and as such does not evaluate, recommend, or endorse any particular investment opportunities. You are advised to consult your professional advisors for specific guidance regarding your investments. Investments are not FDIC insured and are subject to loss, including the loss of principal. So with that out of the way, we can move on here. And there's no pressure. This is the first panel discussion, guys. So, don't feel any pressure about performance or any of that. We're getting this kicked off. A great day, a great 2-day event in Palo Alto with lots of great topics being covered: venture, real estate. Crypto is going to be one of them. I'm sure they'll have a very different attitude than Ed had a few minutes ago. Healthcare, private equity, and much more. Marty, you've done a great job in putting this together. I think 350 people have registered. I think we have about 60 people online right now. So looking forward to really getting this discussion going. But I want people to know that I have a philosophy when I do this. And that is, the more people that talk, the smarter I look. So I want everybody to feel free to jump in and to have a discussion. It's going to be more of a conversation up front with my panelists. They're going to be asking each other questions. They'll be probing, and it'll be done in a way that's very dynamic. To the extent you have a question, type it in the chat. Marty will do it, and I'm going to encourage Marty to unmute people and let them ask the question directly, if you would. Because I think the more interactive it is, the better it is for everyone. So our panel today consists of 3 individuals who are involved with multifamily offices. During our conversation today, we're going to explore such thing as how do fund managers fit into their overall portfolio as opposed to direct. When do they go direct and when do they hire talent for their investments? When hiring fund managers, what are the key things they look for? And Dagmar is going to introduce us to the concept of search funds. So I'm looking forward to that conversation with her. We only have an hour and I can spend all day talking to our panelists about this. So what I'd like to do is really move on and start introductions here. I'm going to ask everybody just to speak for a minute or two initially here. We're going to get in much more conversation. Just give a high level of your firm, your AUM, asset allocation, geography, domains, that sort of thing. So Dagmar, if you would do us. Dagmar Berker is the Executive Director of Nova Stone Capital Advisors. And again, it's evening where she is. So Dagmar, why don't you take it from there?
Yes, good morning, everybody, or grüezi, as we would say here in Zurich. Thank you very much for having us in this conference. Thank you, Marty. It's a great privilege to be able to speak on behalf of our program, and if you will, also our family office, who is a key sponsor of our program, and all the family offices or investment offices who are members of our program. what we're doing is that we at Novastone Capital Advisors, we are a turnkey program for our program members to build discretionary global portfolios with the search fund asset class. And search fund asset class, as you folks out west probably know, is both a asset class that sits between venture and growth, and has as acquisition targets only SMEs in succession in mind, as well as a process on how to invest into this asset class. And the process is, and I'm sure we touch upon this later more, is you go manager first. And with that said, perhaps I give back, or I'd obviously be happy to speak more about this, Mark.
Well, Dagmar, just give us a little insight. Talk about your multifamily office, just a bit more in terms of, what areas are you most interested in right now? What are the bite sizes you like to put into managers, things of that, and maybe you're a little bit different than our other two panelists, and maybe you can point that out too.
Sure. Well, we are South American family office, but we are headquartered here in Switzerland, and it has obviously the usual, for its investment strategies, the usual allocations. And within the private equity space, for the liquid private equity alternative space, the usual allocations. And in the illiquid space, if you will, we are now have almost exclusively decided to allocate to the search fund asset class. And we are, well, I really don't want, we have currently now a program, 30 single family offices. The firepower of these family offices is obviously very large, but we don't want to consider this as any privilege of ours as assets under management, because we are not an asset manager. We are simply an advisor. And typically our family offices who are members of us are more of entrepreneurial spirit, and they are interested to reallocate into this private equity direct space, but have so far not been very enthused about where the returns had been come in with the conventional offerings, or had not really done much about it because they don't have the infrastructure in the house. And so with our program, we're able to accommodate that. The program is really geared towards, well, it addresses, if you will, the entire ecosystem of investing in private equity, but it is also very much geared, it's an open platform. We very much encourage exchange between the various participants in the program, and we very much are interested to continue to work with participants in the program who are looking to develop a very close relationship with the manager or with the CEO to be of the SME that they are backing with their investment. The family itself has more than 10 years, very successful experience with the asset class mainly in the States or in South America. And we have decided to take this concept first to Europe, and now are back in the US or in North America with our program.
That's great.
With our
Why don't we,
program, as far as
Dagmar, why don't we stop it there? We'll pick up with the conversation in a few minutes. I want to get Michelle and Lawrence introduced. So Michelle, why don't you just give us Michelle is Michelle De Buono. He is the Chief Investment Officer of Jordan Park Group. Michelle, why don't you introduce yourself, and just again, a minute or two, very high level on your firm, AUM, asset allocation, geographies you like to play in, domains.
Sure. Hi, everyone. Michelle, CIO at Jordan Park, as mentioned. I should also give a disclosure that everything I'm going to say is my personal opinion, not that of my firm. Jordan Park currently manages about $15.5 billion. We are an outsourced family office. In other words, everything that a family office might do, we do for our families. That is everything from esoteric to very simple investment strategies, and everything from sort of helping plan for tax and inheritance and so on and so forth. We have a philosophy of trying to be pragmatic, not dogmatic. I came from a kind of a university endowment environment that I would qualify as fairly dogmatic. Here, we go active where we think we can add value. Where we don't think we can add value, we focus on cost and tax efficiency. And so we run a lot of separately managed accounts, all the way to pools of assets that we build ourselves, vehicles effectively, that go into the more sophisticated asset class to try to generate some outperformance. I'll leave it at that.
Fantastic. Thank you, Michelle. Lawrence, you're up. Lawrence Richards and Chief Investment Officer of Legacy Road Family Offices. Lawrence, take it away.
Great, Mark. Thanks for the introduction. Great to see you. Marty, great to be here. Ed, fantastic presentation. Tremendous and extremely interesting. Mark, just in terms of the introduction, my name is Lawrence Richards, Chief Investment Officer of Legacy Road. Legacy Road is a multifamily office based in Los Angeles, California. It is an outgrowth of my experience helping to found and run a single family office on the East Coast. We oversee the investments of a group of exceptionally affluent individuals and families, a small group here in the Los Angeles area. We invest in the public and private markets, a little smaller than Michelle's, maybe $500 million under management in terms of advising the different families we have. We allocate up to $10 million collectively for investments, or again, invest in the public and private markets, areas of interest. This ties back to Ed's comment about venture capital, private equity, and COVID and the acceleration of what's going on. And I've been particularly excited about the outlook, let's say, in Silicon Valley, of looking at the future and private equity and venture capital and the exciting things that are going on in those arenas and the exciting companies that are developing really extremely innovative concepts and ideas that I think will transform our economy for years to come.
That's the perfect segue, because where I want to start this is actually sort of taking everybody's temperature on a few different asset classes, or if you will, investment strategies. And tell me whether you think in 2021 you're going to be more aggressive in this area or less aggressive in this area. And we'll start off with just IT technology. And Lawrence, you were the last one up, and I think I know what you'll say, but I'll leave it to you to speak for yourself.
In terms of IT technology?
Yes, sir.
Well, that, I want to tell you, that is a very challenging question. The way I work with my families is each one of them, we have a different situation. So quite frankly, we're piecemealing things together. And I've noticed, I've done a decent amount of research in the industry. There are different solutions, and our families, and I'm happy to listen to others with different ideas, have been reticent or concerned about issues concerning privacy and other issues. So we actually tend to do things in-house. The families have their own. We have developed infrastructure. And so we're using IT sort of within our own infrastructure, with each one of our families. We don't have a coordinated system. It just happens to do with the way we operate.
I meant it more as an area of focus for your investments, not so much are you going to build this out internally for your office? Sorry.
My apologies. Well, look, this is obviously an area of great interest. What we try to do, and Dagmar maybe can speak to this in terms of our investing philosophy, is we try to partner with venture capital firms and other individuals who have great expertise. I myself have knowledge in this area, but we partner with those who are great experts and seek to rely on their counsel in terms of investing in funds, in terms of investing in co-investments, to make intelligent decisions. It's an area of great interest, and we rely on people with different areas to make those intelligent decisions.
Great. Dagmar, since he threw it your way a little bit, would you say your group is more bullish or less bullish on the area of IT technology?
Well, I think in the end for us, for our program, it doesn't really matter whether we're bullish or bearish on IT. It really matters whether through our selection process, we're able to attract or screen or invite into our program an executive with experience in the industry, and whether he or she has a business case, which both our family office and any program members would be prepared to sponsor for the space. And that space could be simply the industry, or it could also be a crossover between industry and, say, geography. So if you will, overall, the only thing that we try not to do is to sponsor two searchers in the same region with the same industry strategy. Other than that, we're entirely agnostic. Typically, real economy, and again, you know, without an industry expert as a CEO to be, we're not going into anything.
Gotcha.
Jump in here 1 second.
I'm sorry, fire away, Marty.
Just real quick, there was an article yesterday talking about how the hedge funds have been selling all their tech stakes. I'm not sure that's what you were talking about or trying to get at, but because tech doesn't do as well in an inflationary environment, maybe Michelle can talk about that.
I'm not sure I heard that. Can you maybe repeat it, Mark? Did you hear it?
I did not catch it as well. So Marty, could you try again?
I'm not sure where the microphone is here. Can you hear me better?
Yeah, that's better.
Okay, so the microphone's here. Great. So everybody here is laughing who's actually on site because we're having so many microphone problems. But so the question is, there was an article yesterday reviewing the hedge fund, buy and sell from the last quarter. And it said that hedge funds were selling technology holdings like crazy because they feel that technology doesn't do as well in an inflationary environment. So wanted to get your perspective and if that's going to impact your investing in venture capital or technology oriented funds.
I'll just jump in quickly on that, Marty. That's a great question. The families whose assets I oversee and invest with, those families, we tend to have a longer term look at things. I don't pretend to manage a hedge fund, or I defer to the hedge fund managers on making intelligent decisions in terms of their returns, et cetera. But we tend to have a longer term view on things and are taking more strategic, longer term perspective. So our trading is a little less constant. Overall, we're excited about opportunities ahead.
Yeah, in terms of why hedge funds might be dumping, and I'm going to speculate here, but valuations are high. We all know that. And typically in a recovery, multiples usually come down across the board. So that's something we have to face. And the trade-off is that compression in multiples versus the growth in earnings. We've seen absolutely fantastic earnings growth that's more than offset, any weakness in multiples. We've seen multiples come down only a little bit so far. I think the statistic I've seen is that in a typical recovery, multiples go down about 20%. So in the context of the market today, 5, 6, 7 turns on the multiple. So you have to have the equivalent or more earning boost to offset that. So that's, I think, something that these hedge funds are wrestling with. In terms of inflation and pricing power, what's been really interesting about this particular crisis versus, let's say, the global financial crisis. In the global financial crisis, the whole tech industry earnings fell, tech writ broad. I'm not talking about information technology subsector here. This time around, there's clearly a separation into what I would call quality tech companies that had, the hallmark of a quality company is a low volatility of earnings, right? That's the definition. And the poster child for that is Johnson & Johnson, right? They churn out earnings every year, no matter what. But anyway, there was a sort of a segment of tech companies that clearly had quality characteristics to them, which means effectively they had pricing power, right? So I think any large cap firm nowadays, I read somewhere that statistic, I think Paul Krugman was quoting this, something like 70% of large cap companies in the US have some form of pricing power, monopolistic like influence on prices in their sector. So obviously, that'll extend in part at least to the technology sector. And so inflation should not be a huge threat to large cap stocks in the United States. I don't know what the statistic for pricing power is elsewhere.
A quick question. So just following up what Marty and you were talking about a second ago. The IT sector seemed to do very well during COVID. Prices shot up. So could this be just a reaction now that COVID's coming to an end? They're expecting companies like Zoom, obviously it's gone through its fast acceleration now, but maybe they're expecting fewer gazelles in this area?
Again, I don't run a hedge fund. We're more long-term investors, but
I'm saying that has an impact though on the private markets. It has an impact on the multiples that you pay.
Yeah. So I would say that, if I were running a hedge fund, and I used to work in one many years ago, right? It's a relative value game. So it's maybe not that you're less interested in tech. It's maybe that you're more interested in, cyclicals or other firms that are going to benefit from the reopening. So I think there's probably some of that going on there.
Gotcha. So other strategies that are being looked at: healthcare, real estate, debt, distress, crypto, early stage venture, SPACs, hedge funds. As you guys think about these, which are the ones that you're shying away from, and which are the ones you're gravitating towards? Michelle, I'll throw it to you. You have a smirk on your face there. So,
well, I mean, you basically listed the entire investment universe, right? So, I think it's the devil in the details. Mm-hmm. In the private markets, we obviously seen, fantastic sums of money being raised. So, it's harder and harder to find, great opportunities there. And, like Lawrence, we sort of partner with other managers in that space. I think right now, there's still some interesting opportunities in the earlier stages. Growth equity, nowadays firms can scale very, very rapidly. So once they sort of proven that they can generate a few $1 million of revenue, and they just need sort of extra capital to execute, you can get very fast growth there. The multiples, of course, multiples on revenues are very, very high. So you have to believe in the growth story. But the growth story so far seems pretty exciting. And firms have been delivering on that growth. Not all of them, obviously, but many of them.
Lawrence, you have anything to add?
Just to jump into what Michelle said, in terms of the overall, again, we work with managers, and we're not operating as a hedge fund. But what I liked what he said also on growth, which quite frankly is one of the areas we're looking at. Quite as I said before and indicated before, I think there's a lot of excitement going forward. You mentioned SPACs. When I'm investing in companies and they're going to go public through SPACs, just remember, SPAC is a vehicle to go public. SPAC is not, for me, it is not necessarily an investment strategy unless one is investing in a firm that specializes in SPAC arbitrage and early investing in the entities, and there's a lot of technicalities. So putting the technicalities aside, one should realize that SPAC is our method of going public. So when I'm investing in a company, I understand it's going to go public through a SPAC. I don't necessarily look at that company as a SPAC investment. I look at that, I'm investing in the company because I believe in it. They're making a strategic decision to go public through a SPAC. They may change that decision and go public through a traditional IPO. So, but within the growth space, I think there's tremendous opportunities. I think there's frothiness as well. But again, it's on a company by company basis, on an industry basis. But I am excited again in terms of what we're seeing in the opportunities ahead, driven by technological change.
Yeah, just to add to the SPAC story there, like everything in investing, there's always more than meets the eye. The SPACs have IPO'd relatively small amounts, not all of them, but many of them relatively small amounts. And so really their ability to execute on a deal depends on whether or not in the PIPE transaction that happens, whether they have the capital. And we don't know that, right? We don't know that ahead of time. Some SPACs have created forward purchase agreements where at the IPO, large pools of assets have agreed to come in during the de-SPAC process with additional capital. So let's say they raised 200 million in the IPO, but actually they have $1 billion. That's a very different SPAC than the SPAC that raised $200 million and has not secured a forward purchase agreement. And in my mind, we'll have much more difficulty executing a transaction. These things are very hard to know. You can't just sort of figure out who's done what just by sort of looking at some stock price.
Gotcha. Dagmar, anything you want to jump in here with? Not so much on SPACs, but on areas that maybe you're looking to be more aggressive in, areas that you're looking to be less aggressive in?
Yes, for us, for our program and for our families who are building, I mean, coming back to your question, how big are the portfolios that the families are looking at to build either here in Europe or in the States? Sweet spot is typically around 25 million upwards. 100 million is sort of what they're all anticipating and more. I mean,
is that what they're looking to invest or what they're looking for in total valuation size?
Invest, like hard money put in. Okay. Now, coming back to these valuations questions and whatnot, and whether or not a company is priced properly, is for us when we look at the process on whether or not we want to decide to invest in a company is comes secondary, if you will, because it is a combination first and primarily, it is again, you know, the manager who has a view on a market or on a strategy. And it is only if and when that manager is fully sponsored by our program members, then he or she can go ahead and seek the targets. And when the targets are being identified and brought back to the program and looked at by my colleagues in the M&A team, we make sure that we are looking at, again, at SMEs in succession, that we're not looking at special situations, we're not looking at startups, we're not looking to financially engineer, we're looking at a investment case to be brought back to the sponsors of that individual manager, whereby there is which is a combination between hopefully not considering more than 6 times EBITDA multiple when purchasing, and combining that entry level with this growth strategy of the CEO. So it is the CEO to be, or the manager, who then has to create the business case for his cap table or for his sponsors. And it is that question that needs to be answered and needs to be satisfactorily answered by anyone backing him or her in order for the transaction to go forward.
Great. So just to be clear, and I think this is what you're describing, you first locate the person, and then have them bring forth business propositions to the group to present them, and you help them along the way.
Yes, and so perhaps to just give you an example on what we look at, or my colleagues look at, and I truly bow my head to them. This program at Novastone Capital Advisors, outside of what the family continues to do in the conventional asset class or space, this program we launched last year in the summer in the midst of COVID in Europe. We have today, and we are committing to our program members to bring to the fore, on average, 1 new manager every month, on average, in every greater region. Today we are in Europe and in North America. We have an office in Boston. Today we have, we're coming up to 12 managers. And for those 12 managers to be in the program, my colleagues look at over 3,000 CVs.
Fantastic. Now I'm going to delve into that a little bit later, but I think what I want to do is just take this and pivot a bit because you're hitting on the right area. And so Lawrence, why don't you take care of this question here? You work with a number of multifamily offices, and many of your people are very talented, strong entrepreneurs who've built and developed businesses. So when do you decide, or how do they make the decision about or that they want to invest in a certain area through a manager as opposed to going direct? So maybe you could speak to the direct versus going through a manager and
Great. Happy to speak to that. First of all, I will say that the devil is always in the details. In terms of going direct, easier said than done successfully, because it's very easy to do. You just write a check, right? But we know that it's very important to do the proper due diligence. And I have learned through my career that investing in direct is very tricky. And that's why there are built-out private equity firms that do this. And so what I try to do is partner with firms, private equity firms, venture capital firms that have a meaningful infrastructure of talent, of perspective, et cetera. So what I do in terms of diligencing those, and that's a much longer discussion, but I will say that it comes down to a few things. It comes down to team experience within that team and the team members and how they work collectively. Number two, strategy. And it's just like, you know, if you're in business school and you look at a company, the firm should have a unique, competitive, sustainable advantage, and something which is very unique that they offer in terms of their management philosophy. There's a hedge fund that does X, and it does X in a very unique fashion and does it better. And the third element, and I would call this something intangible, is the relationship. And I try to get to know the managers over time. We build a relationship. I like to see their level of transparency. I get to know them personally as well, quite frankly. I speak to references. So I'm not simply making objective, analytical or mathematical decisions, if you will, on who I decide to choose, but rather that there's a nuance to it. So those are my views overall on this topic.
Great. Marty, before you jump in here, I want to let Michelle, because he and I had a very interesting conversation about this in our prep call. So Michelle.
I just wanted to talk just a bit about this whole direct. So, you know, as we all know, direct is the big fashion, right? So everyone talks about doing direct. In fact, people conflate a lot of things. You might see people say direct and co-invest as if they were similar. You know, they span the range. So at one end of the spectrum, you're an investor in a large private equity firm. They send you a deck with all their analytics in a particular investment of a particular company that's already in their portfolio typically, but needs to be upsized. You sort of glance over it, you say, sure, you sign a piece of paper, you give them money. That's called direct, okay? To me, that's you've outsourced absolutely everything, right? All the way at the other extreme is you go and buy out some small cap company, kind of like what Dagmar's doing, right? You know, and then there's the middle, where I think for larger entities is probably a good place to operate, where if you have people who can underwrite things themselves, you might look at both ends of the spectrum, but you're still going to have your own underwriting process, which is an important part of the due diligence. You know, you may get comfort if it's a sponsor-backed company. You may not invest in their fund, but go directly into their crown jewel asset. Sometimes they let you do those kinds of things. So you can sort of have the benefit of having a sponsor or someone managing it without paying for it. That's great. You can do that. You know, or you can go further down the spectrum towards, again, the kind of stuff Dagmar does. That's a lot harder because you have to find people you trust to manage things for you.
Yep. It looks like somebody's got and they need to mute, and I think they did. So thank you for that, if Marty, if you did that. Michelle, I just wanted to stay on the topic here a little bit here, because when we spoke last week, one of the conversations we were having was around, you know, personally for you, when you make a decision to use a manager and when you decide to do direct internally. So why don't you just address that quickly, then we'll get to Marty and his question that he's bringing from the audience, I assume.
Yeah, so just very briefly, and I touched on this during my intro, I think that, it depends where there are more or less market inefficiencies. So large cap listed equities, the potential for sustained outperformance year after year by a particular manager is low. There's about this much academic literature showing that, right? So there, no need to waste a ton of precious team bandwidth, try to go more for cost effective, tax effective type things. In areas where you think you can generate more and more alpha, then more and more structuring, more and more work is relevant. So in the direct area, you can probably generate a lot of outperformance, but it's going to require specialized people who know how to underwrite these things, who, when they look at the PE sponsored backed deck that has all the statistics in it, say, why is SG&A 30% of sales? That seems high, right? Many people don't have that type of insight. So you need to have enough professionals around the table that can look at these things, debate with whoever is offering this thing. And so then you should have more investment in your team and your effort there. So we try to sort of change our investment in the area based on the inefficiencies and therefore the potential for outperformance in those areas.
Understood. And one of the areas, I think you mentioned that you will never hire a real estate fund manager. Maybe that's a little bit of an overstatement, but yeah, I think your point is you believe you have so much skill and knowledge internally that would be hard for you to foresee that.
Yeah, that is an overstatement, but depending on the industry, you can sort of it's very hard, again, in private equity, and this is exactly what Dagmar is doing, by the way. It's very hard to find CEO in a box. Okay, I can't go buy some local company and then hopefully find a CEO to run it, the way I want to. In real estate, the industry has been quite decentralized, right? So there are lots of real estate management companies that manage the assets. It's a known price to do that, right? They have reputations. They do this as an outsourced business. So I can go find someone to do that. I can go find a developer to develop something. Again, there's a known price for that. There are known players, right? So it's easier to disintermediate real estate than it is, not always, depends on the asset type and whatnot for sure. But it's easier than in private equity, where again, there's not a firm out there, right, where they have 20 CEOs that I can sort of pick one and pay 27 basis points or whatever it is to go run my company in an approved, well done way, right? And so this is where, people like Dagmar come in and go through thousands of resumes to find the people that they will then anoint to go and then find the target company. Right?
And I think that's so valuable for fund managers and people to hear, because they don't always approach you in that manner or thinking in those terms. Marty, I want to toss it over to you. I think do you have a question, or are you just coordinating?
You can hear me fine. Can you hear me okay?
I can hear you fine.
Perfect, great. Okay, so actually, Michelle kind of went over to one of the questions that I have, but I have a different question, which is that, and getting to something that Lawrence said, which is that private equity is in flux, right? I mean, the deals are getting bigger, and there's more deals. And regardless of COVID, there's still this huge amount of people who are going to retire who want to sell their businesses, right? So, I don't think it's something that is so easy for family offices to just walk into and start operating in the private equity space. So I was hoping that, Lawrence and Michelle and even Dagmar could talk about, the difficulty of operating in private equity, getting expertise. And a lot of these private equity firms have been around for, 10 or 20 years. They have a significant knowledge of how to work around a deal. And, so a private equity firm has a stack of knowledge. They have people who, are deal junkies. They've got financial modeling people. They have people who know how to model things for credit markets, et cetera. And for a family office to enter into that space, they need to kind of acquire and do well. They need to acquire all three of those skill sets. So I was hoping that you guys could talk around that, about how to be realistic for what sort of deals family offices should approach versus, what you seek out in funds. So
I'll just say quickly, Marty, as I was mentioning before, I've learned through my experience, this is a very tricky area. doing these type of deals, it's very important to have partners who are very smart and very skilled and with feet on the ground. And so what we do is we seek to invest, if we're doing, as Michelle was speaking about before, you're doing a direct deal, but it's essentially completely outsourced in terms of much of the work. It's whether I might even call that a co-investment. We can debate what the word co-investment is versus direct, but I will just say it really depends, for me at least, on who my partners are and what their skills and knowledge is, and then I'm happy to make those investments if the situation is right.
Right. Yeah, maybe I can pick up on that. The way we obviously are aware of that, and we are aware of the difficulties, and the way we are addressing it in our program. We are now I have 20 colleagues, and we covering all the disciplines. I think I mentioned it, from, if you will, the HR all the way to M&A, legal, compliance, you name it, product solutions, and so on. And portfolio report. I mean, if you will, all the disciplines that you would expect to be covered by anyone who calls him or herself as running some sort of a shop in that space. The way we address some of these issues or pressure points of family offices is that when we part of our process of bringing new managers into our program is that we require that they themselves bring into, we call it their cap table, or as sponsors, industry experts or geography experts, which then makes the whole business case a different case, because that allows then every family office or investment office, after having interviewed the manager and whatnot, it allows for another perspective or view on a strategy or on a market or on a business case than if it was continuously, if you will, deal first balance sheet engineering. I should also say again, our deals in the space where we are in, which is we're looking at opportunities below where private equity firms are interested, is a space again where financial balance sheet engineering will not create the desired return. It has to be talent. It has to be the interest of of certain members or family offices or the entrepreneurial investment offices, if you will, to proactively contribute to the growth case of that particular situation. And it so far this has proven to be a marvelous situation, because it also allows, in our situation or in our program, for family offices who are members to introduce to the program either in any cap, either to the program as a whole or to any cap table where they are sitting in, deals that come to their attention in their daily works, and they don't have the infrastructure or the know-how in the house to analyze them, but would like to see introduced to the program. So it is, yeah, it's a different way in how we approach it, and we believe it is in that space, it's a collaborative way of going forward, and it really leaning on the manager or the CEO to be on and supporting the generate return, which, by the way, is, if you will, their incentive to do that, because if at the exit they stand to earn quite a nice package with the carry.
Let's just take it from the theory and sort of the high level discussion. Why don't you talk about the last manager you brought in through your program, Dagmar, and how that worked, how you found the person, what got the group interested in them, how they progressed through the investment phase and got the backing of your group to go out and find a company to invest in. I made the mistake of calling Dagmar's program a private SPAC during our call. Don't do that. But but it is similar in some ways to SPACs in terms they're backing a a management team as opposed to a specific business plan. But they're then sent on to find a business plan. So Dagmar, why don't you sort of talk about how it's similar, how it's different, but specifically go around the last manager you brought on, how you found them, what attracted you to them.
Sure. I mean, it matters not whether the last one, but any manager who we bring into our program are mid-career professionals. They are all at a juncture in their business life where they are wondering whether they should remain corporate or whether they should go out on their own. Why are they thinking about going out on their own? Because they've made a name for themselves over perhaps the last 15 or 20 years in which they've been active as operators or even CEOs in companies. They've created an amazing network and they see opportunities. And they have often had the itch of activating, if you will, those passive opportunities or that passive network upon which they couldn't act simply because of the bind they were in their company. So here these are all talents with background in industry, and they have most of them have been exposed to the private equity markets for various reasons. And so they are quite familiar with the approach, with the analysis, with the expectations. But they also know that they do not have their own capital to go out and simply go out and buy a company. So what we're offering them, and so regardless of how they have become introduced to the asset class, again, you know, I say it's an investment, it's an approach. It is for them an opportunity to prove themselves to a group of co-investors, and they prove themselves at the point at which they have been sort of screened for our program or assessment center. And that is a 3 to 4 month cycle. It goes over 5 or 6 steps of screening or interviewing. And in our case, the family office's principal becomes at the latter stages rather involved himself. And at the last stage, these candidates, if you will, they have to present to the programs. So that means the Novastone Capital Advisors advisory board, they have to present their business case, and they have to also bring already targets to the presentation, which they would like to have any backer have a closer look at, and have to build a case as to why the advisory board should make a recommendation to the investment committee of the family office to go into their cap table as a leader, and then open up this cap table to all the members in the program, and so that everyone sponsors the strategy together.
Gotcha. Lawrence and Michelle, I sort of want to put the same question out to you two. Think about the last group that you backed, and what sort of, how did you meet them? How did you source them? What got you interested in them? And why did you go with them? So, and Lawrence, you sort of touched on it different. You look for, you know, some way that they separate themselves from the other, 1,000 managers looking for money. So take us through that a little bit.
Okay, I'll speak briefly and then hand it over to Michelle. It's a great question. It's funny you mentioned it. The last significant manager we brought on, I actually interestingly enough met through a cold email.
Wow.
Through LinkedIn. And I often get these emails from LinkedIn from managers, and there are a lot of quality people out there. And we have different discussions, and some emails seem more interesting than others. And for whatever reason, I thought it was just a very nice, for lack of a better word, clear email. And I just said, sure, I'll have a meeting with you guys. And I started speaking to them, and I had many conversations with them. And
if you can, what area are they investing in, and what sort of strategy are they using?
They do. I don't want to mention the firm on this call.
Understood.
But they're focused on breakthrough scientific discoveries, and post-engineering risk, if you will. So they have a unique strategy. They have a great team. It's very interesting. They had an amazing track record, and they were extremely transparent in terms of the materials and the data room and everything else. And I had many, many conversations with them, with many different professionals who worked at the firm, and again, with references, a very senior Wall Street executive who was one of the first investors in the fund. And it's been a very interesting relationship. So sometimes these relationships can develop from the most interesting avenues. You never know. It doesn't have to be through something so formal as a good friend or a colleague. And that's the way it developed.
And in terms of when they reached out to you, met them, and then there was a few months before you made your investment in them, did they already have money under management, and were they making investments that you could then sort of look at and see and, sort of touch and feel and say, okay, I get how your thinking's going?
Yeah. So generally speaking, I have a philosophy which is not too big, not too small. It's not a hard rule, but it's a general rule. If it's too small, unless it's an unusual situation, when I see too small by AUM, then it's hard for me to discern whether it's an intelligent move to invest. But that's not a hard rule, because sometimes there are individuals coming together to form a fund with great skills, experience, etc., who I believe in, and will make an investment. On the other hand, too big, maybe there's the incentives aren't there anymore. So these guys were right in the middle. They were perfect. They had about a couple $100 million under management. They were raising their second fund. Their first fund had a great track record. They had a lot of interesting deals. They had a lot of interesting co-investments. Interestingly enough, some of them were going to go public through SPACs. Don't want to go down that route right now. So there were a lot of interesting things going on, which made it very exciting for me. And I decided at a certain point to pull the trigger.
Fantastic. Michelle, I'm going to throw the same question out to you. So, tell us about your most recent investment in a manager, and how did you meet them? How did you source them? What got you interested? How did they separate themselves from the other 1,000 managers that were out there?
Yeah. So, thousands is the right word, the number that we filter through annually. And sadly for many of them, undifferentiated strategies, trying to charge full freight fees, very difficult to sort of pierce through and differentiate yourself that way. Many of our opportunities, if not most, come from our own ecosystem. Either from our families or stakeholders. And so we get a lot of proprietary deal flow, I guess you'd call it if you were an investment banker. So we look at that. And to me, some of the differentiating characteristics are people who are really interested in having a true partnership, right? Who don't view you as sort of, a source of funds off of which to enrich themselves, but as a collaboration where certainly they can enrich themselves, no doubt about it, but that also they will bring a lot of benefits to our clients to the table. And so a lot of it is around those discussions. Often we prefer to go with, earlier in their life cycle managers if we can, if they are amenable to sort of a true partnership in that sense. That word partnership, unfortunately is abused nowadays. A lot of people use that word, but don't actually sort of act in a way that would reflect my interpretation of that word, which, as I said before, is, mutually beneficial to our clients. So
could you just provide a little detail about the group that you invested with? Again, you don't use their names. I'm not looking for that, but give us a sense of what industries were they investing in? What was their strategy? Was it private equity, venture, real estate, whatever it may have been?
Yeah, it was a growth equity firm most recently, very connected into Latin American startups.
Interesting.
And had a great access to even existing companies, and very humble, even though fantastic track record and accomplishment in life, and really willing to sort of build a partnership. We came in and were an initial investor in their fund. For that, they gave us a lot of preferential economics, access to deals, whatever. And we sort of talk regularly about whatever might come up that is in their niche area of focus. So it's really about finding specialists and then establishing a dialogue with them to stay abreast of what's happening in that area.
So how did they get you comfortable they're actually going to be able to complete the raise?
We usually allocate enough capital to make them at least somewhat viable from the beginning. And then obviously, during the diligence process, we're going to discuss with other potential investors, and it's a small world.
Yes.
Usually they're 1 to 2 degrees of separation from us. We can triangulate quite rapidly on them.
Lawrence, I don't know if you saw, but we had a question coming from our audience here directed towards you. And they wanted to know if you could provide more details on how SPACs have changed your perspective towards exiting PE deals.
Great. So again, I want to reiterate that when I'm investing in a fund or what I'll, for the sake of this call co-investments, I'm investing in the company because I believe in the company. Having said that, what's interesting about SPACs is it's giving a quicker path, a strategy for a quicker path to liquidity. So that can potentially make an investment in a company, medium, late stage growth, or wherever they are on the cycle, but they think they can have a liquid event through a SPAC. That can make the investment much more appealing, quite frankly, because there's so much appetite out there in the SPAC market for these type of deals. Having said that, it is important to focus on the type of company. And I will say that we have done these investments. One of them is having a tricky time with certain issues. Michelle was referring before to pipes. These are quality companies. We had no issues with that. Sometimes going public can be a little more tricky than usual. So you can't rely on it. I'll put it like that. You cannot rely on the process, but it's out there. And I will say as a backstopper in terms of my information flow, the area of SPACs is very particular. It's very technical. I happen to be an investor in a hedge fund, which is a SPAC expert. So I have colleagues there that I speak with. So again, I caution people not to look at SPACs as an area of investing, so to speak. You really should be focusing on the company. It's a strategy to go public, unless you're into SPAC arbitrage or the different technicalities. You need to look at it a little maybe differently than the press is portraying it.
Fantastic, Lawrence. And Marty posted up here at some point that we have 5 minutes left. I guess that was at 1:10. So we're at the point where we're now going to wrap this up. So I'm going to ask everybody just to sort of make a closing comment and to just sort of wrap up what you want to get across to people. And Dagmar, I'll start with you. You haven't spoken in a few minutes, so we'll let you have the first word at this. So.
Sure, I'll try. Well, hearing where my colleagues have to go through and analyzing and technicalities, I'm quite happy that we, with our program, we don't have to do that, which doesn't mean that we're not looking very seriously at every deal. Because in the end, it is a knowledge about how to structure deals. It's knowledge how to look at a market. It's knowledge also in what can be accomplished with a company, regardless of what's written on paper. It's people who have to make it work. And for us, it is also knowledge that we have with our program, experts or members. We call them members, family offices with all sorts of expertise and know-how in the program, to whom we can reach out and who are reaching out to each other to make each other's investments grow. Because the goal is not to if you will, to feel better about having passed on an opportunity, but to feel great about an opportunity where you have invested and had gotten a great exit. And the exit or the liquidity events that we are looking at are the earliest 2.5 years after entry, but certainly sort of 5 years after entry. And it is ultimately also driven by the performance of the CEO.
Fantastic, Dagmar. Michelle, your closing comment here.
Actually, I'll make a sort of high level reflection on this industry now that I think about it. It's always been fascinating to me how the investment industry somehow seems to entertain thoughts and investments from people who are not experts. And so I always use the analogy, if we were all medical specialists and we went to a medical conference and the person presenting at the podium knew nothing of medicine beyond having written some blogs or something, they wouldn't even be at the podium, honestly. And yet in this industry, we sort of entertain that type of thing. So I would suggest that, believe it or not, there's actually expertise also in this industry. And look very carefully at the resumes and the pedigrees and what people have done actually. Have they had P&Ls in their life? Have they actually run things before you sort of invest with them? Because a lot of the sort of disaster stories you hear about or see are precisely when people who project perhaps are articulate or thoughtful, but not necessarily experts, end up getting somehow capitalized. So that's my high level takeaway.
It sounds like good blocking and tackling strategies right there, getting down to the basics. Lawrence, final word here.
Yes, I want to echo both what Dagmar and Michelle in particular said. Prior to Michelle speaking, I had written down the word specificity. And it really is about, Michelle, as you're saying, investing with the right people, being very careful. You mentioned vetting resumes. It's a very interesting topic. And firms, and really digging in to what they're doing and what they've done, and taking the time to do it, and taking the time to get to know people. And the second thing you said about expertise, there is expertise. No one knows everything. You want to find people who have the expertise and you can also trust. And I'd leave it at that.
Fantastic. Well, I really want to thank Dagmar, Michelle, and Lawrence for the time they gave this afternoon. You guys were fantastic, made my job very easy. Marty, with that, I'm going to turn it back over to you. I can see our next panel group is all set. So before we go, a little hand for our panelists there. Thank you very much.
Thank you.
Great job,
Thank you very
guys.
much, Mark. Thank you so much.